Good morning, Ian. There he is. Good to talk to you again.
Okay.
As usual, I'm going to hand over the reins to you and let you tell us a bit about Temple Bar, and then we'll do some questions.
Brilliant. Thank you very much. I'm going to talk for about 15 minutes. Really the theme of what I'm talking about is that any UK equity fund manager that you've seen present in the last couple of years will have told you that UK equities are very cheap. And we think they are very cheap. I think what's very different this year is that we've got two very clear catalysts have appeared that are realizing that value. And, we'll touch on this at the end, but the share price of Temple Bar's up about 18% year to date. So we've certainly seen those catalyst starts come through in our portfolio. But I'm going to start here by talking about the fact that we, myself and Nick Purvis, who run this fund, we were brought up in that school of fund management in which you believe that fundamental research and valuation are very important to your future returns. It feels like there aren't too many of us left these days, but we still believe that. And I suppose I'm trying to prove that to the audience here. So what we're looking at here is 100 years of data of the American stock market. And across the bottom, across the x-axis, we've got valuation. So this is a sort of market cap to GDP type of ratio. Cheap is over on the left-hand side, expensive is on the right-hand side. And then up the y-axis, you've got the annualized returns that you made for the next 12 years when you bought the US market on those valuations. So I think it's always easiest to give you an example here. So if you just take your eyes to 0.5. So when you bought the US stock market, when it was cheap, go up to where the blue dots are, you made about 16 to 18% per annum. If you go to where 1 is, so that when you bought the US stock market, when it was on an average valuation, funnily enough, you made an average return. You made sort of 8 to 10%. And then go to the right-hand side. Now, on the right-hand side, that arrow is where we were at the end of last year. I've actually got an updated version of this, which basically shows you that the US stock market today is on that far right-hand point. So it's never been more expensive on this measure. And, buying the American stock market at the moment, you should expect to lose between 4 to 6% per annum for the next 12 years. Does that mean the market can't go up in the short term? No, of course not. As Ben Graham said, in the short run, the market's a voting machine. In the long run, it's a weighing machine. So, of course not. But, over the next decade, the odds are substantially against you. And I would just point out that the R squared, so the correlation of this data is minus 0.93. That is a pretty good correlation. So you really are betting against history if you're a big buyer of the American stock market today. Go to the next one. Okay, so we've said that valuation matters for your future returns, and we've said that the US is expensive. So what's cheap? The UK is cheap over on the left-hand side there. That's the valuation of the UK relative to MSCI World. This is a 50-year chart. So this goes back to the mid-1970s. We're basically the cheapest that we've been since the mid-1970s. So 50-year low valuations. And people will often say to us, well, the UK should trade at a discount because it's got a very different makeup of its sectors. So UK has got higher weightings in financials and energy and things like that. US has obviously got higher weighting in tech and so on and so forth. But to a certain extent, I agree with that. Absolutely agree with that. But I would just, I guess, point out two things. Number one is the dotted line across that chart is the 50-year average. The 50-year average is minus 17. Today we're at minus 45. So, even including that difference in sector composition, we are at a very wide discount today. Over on the right-hand side, it's the valuation of sectors, UK sectors relative to their US equivalents. And I suppose the interesting thing here is even if you take a global sector, so a sector where the companies don't really depend on the UK economy at all for their profits. So let's take energy. The ones listed in London trade at half the valuation of the ones listed in New York. So BP and Shell trade on about 6 times earnings, and Chevron and Exxon trade on about 12 times earnings. So again, that doesn't seem to make sense to us. So we still think the UK is cheap. I think we probably all know that. So let's move on and talk about the catalysts. Go to the next slide. Two very clear catalysts have appeared this year. The first one is takeovers. So this chart here is showing you the average number of takeovers of UK companies per year for the last decade or so. And you can see on average, we have about 40 companies taken over per annum. Last year, that jumped up to 64. And this year, the run rate is way above that. In the first 4 months of the year, we had 4 stocks on the Temple Bar portfolio bid for. So we had Currys, Direct Line, IDS, which is the old Royal Mail, and Anglo American. If I updated this chart to today, obviously I would be adding companies like Hargreaves Lansdown, Darktrace, DS Smith. So, the bids have just carried on. What does that tell us? That tells us that US companies, in particular private equity, are looking at the valuations of these UK companies, and they just can't believe their luck. Some of these things are just so ludicrously lowly valued. And these people are committing billions of dollars to taking out UK companies. So I think that's one very clear sign that UK companies are very undervalued. And obviously it's a double-edged sword, because obviously it's great news when you come in and some stock that you own is up 40% on the day because someone's come in for it. The downside is, number one, I suppose you don't want too many companies disappearing off the UK market, and the other one is you don't want to be selling these companies too cheaply. And we've been very active in the press this year, actually arguing that a lot of these offers we thought were opportunistic and too low. So that's catalyst number one, corporate takeovers. Catalyst number two is share buybacks, and just to give you a little bit of context here, because we still manage over £4 billion across all our portfolios, and we run quite concentrated portfolios, so sort of 20-25 stock portfolios. In the companies we own, we have we're quite big shareholders of them, so we are the largest shareholder in Currys. We own 15% of Currys. We own, with second largest shareholder, Marks and Spencer's, second largest shareholder of IDS behind Daniel Kretinsky, the guy who's bidding for it. So we get quite good access to the management of the companies that we invest in. And they have been a pretty gloomy bunch for the last 2 years, because they come in to see us and they say, what's going on? My business feels like it's doing really well, and my share price does nothing but go down. And I'm sitting here trading on a P of 5 and a dividend yield of 8. And what on earth is going on? And we have to say to them, look, don't take it personally. There is just this kind of valuation agnostic selling of UK equities going on as people chase the US market, or just because people have decided to go global. But we have said to these CEOs, rather than get gloomy and depressed about it, use it to your advantage. And the way to use it to your advantage is to buy back your own stock, because when your own stock is that cheap, there's pretty much nothing else that adds value for shareholders than buying back your own stock. And so turning to this chart here in front of us, basically what this is saying is that message appears to have got through to UK CEOs, because the green line shows you the number of UK companies that have bought back their own stock in the last year. And that line, a few months ago hit 50%, and that line is higher than any other market in the world. So UK companies are now buying back their stock at a faster rate than any other company in any other market in the world. Go to the next slide. Just go actually flick on one more. And I think sometimes, share buybacks is a bit of a dry subject, and it's certainly not as exciting as talking about sort of, growth potential from AI. But I think people underestimate how powerful it can be, and that's what we're trying to show you here. So I've got a case study here. The case study is Next PLC, the retailer. We start on the right-hand side. So those of us who were investing back in 2000, I suppose, remember it being fairly reminiscent to today, actually. Everyone was incredibly excited about the growth potential of technology shares, and nobody wanted to own old economy shares. And so shares like Next were very cheap, and the share price there, that was about £5 in 2000. Roll forward to today, the share price has just gone through £80. So that's an annualized return of 16% per annum. The interesting thing here is if you go to the chart on the left-hand side now, so you can see that right-hand green bar tells you the annualized total return for shareholders, 16%. Now look at the sales growth. Sales only grew at 5% per annum, just about 5.5% per annum. So how do you produce 16% per annum total return when you're only growing your top line at 5%? Share buybacks. The CEO of Next is a chap called Simon Wolfson, and he is the master at sort of capital allocation. So, the first thing he does obviously is invest in the business. Obviously, he created Next Directory over this period, and that's now more than half the profits of the firm. But with any surplus capital, he buys back shares, and he only buys back shares when they're cheap. When the share price goes up, he turns off the share buyback and goes to special dividends. But the incredible thing is, over this period of time, he's bought back 2/3 of the shares in issue. So there's only 1/3 of the number of shares in issue today that there were back in 2000. And if you go, staying with the chart on the left hand side, look at the EPS. So when you've reduced your share count by 2/3, even if your sales are only growing at 5.5%, your EPS and your DPS you can see are growing at 10% and 12% respectively. And then you've had a bit of a re-rating. Go to the next slide. I think this is even a more spectacular one because, again, 2000, nobody wants old economy. Nothing is more old economy than tobacco. So this is British American tobacco. Share price in 2000, £3. Share price in 2015, so only 15 years this time, 50 quid. So that is an annualized total return of about 24% per annum. And now, again, look at the sales growth, 1% per annum. So you have 1% per annum sales growth, and you turn that into 24% per annum total return. Again, by doing the same thing. These shares were incredibly cheap. They generate a lot of cash. They bought back a lot of stock. And so look at the EPS and the DPS. Again, you can see sort of about 14% earnings per share growth because they reduced the share count but so significantly. So share buybacks can be very, very powerful. Go to the next slide. So now let's kind of roll this forward to today's portfolio and show how these total returns are rewarding shareholders. So here we've got 8 companies that we hold in the portfolio. We've got 3 energy companies, an auto company, Stellantis, 3 banks, 1 insurance company. And I'm just going to sort of run you through these figures quite quickly. So the first column is 2-year earnings per share yield. So what we've done there is we've taken the earnings per share that were produced in 22 and 23, and we've divided it by today's share price. So, how much of today's share price have you had in earnings per share over the last 2 years? Just have a look at some of those figures. So oil companies, 40-odd%, Stellantis, 65%. You've had 2/3 of today's share price in earnings in just 2 years. The banks, about 1/3, and about 1/3. Next column across, same sort of mechanism, but this time we're looking at dividends. So what dividends have they paid in 22 and 23? Divided by the share price. Energy companies about 10, Stellantis 15, banks about 10, and then about 14. So that's not too bad. Now let's go to share buybacks. So what share buybacks have they done in the last 2 years? Again, divided by the market cap. So energy companies about 20%. The standout here is in the middle of the banks, NatWest there. So NatWest, about 30% of their shares they've repurchased in 2 years. Just go back to that Next example. I mentioned that Next had bought back 2/3 of their shares in issue, but it had taken them 24 years to do it. NatWest have done nearly 1/3 in 2 years. I mean, it's just absolutely extraordinary. And so I suppose the final column is if you add together the dividends and the share buybacks, and so you what we call a sort of cash yield. So what have you, the shareholder, had back in 2 years in terms of dividends and share buybacks? Again, look at NatWest, 40%, the oil companies, 30%. And I think the fascinating thing here actually is that this has really started to come through. So I think the share price of NatWest is up about 60% year to date. Barclays up 50% year to date. So, and you kind of expect that, wouldn't you? Because just think about this: if you are reducing your share count at that sort of rate, so if you're reducing your number of shares by 30% in 2 years, let's assume that the net income just stays the same. Mathematically, your earnings per share are going to be 30% higher, aren't they? Because there's just 30% fewer shares in issue. And so if the share price doesn't go up, then obviously the valuation just gets lower and lower and lower, and you're already starting at a very low valuation. So as I say, I think it's fine. The penny has finally dropped to these companies that they need to take advantage of their low valuations, and they are, and it is having an impact. Just go to the next slide. So this is just a snapshot of the portfolio today. I'm not going to go through all these companies, obviously, but I just make a couple of points. Some quite big weightings. We do run quite focused money, so typically you can see positions there between sort of 5 and 7%. The amazing thing here is, so Nick and I have run money for over 30 years. We think that the valuation of this portfolio today is probably the lowest we've seen in 30 years. So the average PE across the portfolio today is 8. That we reckon that's the lowest we've seen. That's lower than we saw in 2008 or in 2000. That is normally a precursor to good returns to go in the future. And if I can, James, if I can just finish with one slide, and then I will pause and take questions. So if you could just roll forward to the performance page, this one here, yeah. So I've updated this, and I suppose the point I want to make here is and I'm not just kind of banging on about the performance. I suppose the point I'm trying to make is there's kind of an obsession, isn't there, with US equities and Mag 7 and so on and so forth. And when I take you through these figures, what you'll see is that you can make really good money in UK equities. If you buy very cheap UK equities, you can make very good money and interestingly better than over this period than you've done in the US. So year to date, Temple Bar's up 18, the UK market 10, the S&P 15. 1 year with Temple Bar 25, UK 17, S&P 25. 3 years, 43, UK 22, S&P 28. And then since inception, we took it over in October 2020. Temple Bar's up 126, UK market 65, US 77. So we're actually ahead of even the US market over every time period, that we've been running. So, people are incredibly negative about UK equities, and the point I'm trying to make is, if you buy really lowly valued UK equities, you can make some very, very good returns. And that's all I wanted to say, and happy to take questions.
Brilliant. Thank you very much, Ian. Where should we start with? Actually, one thing that I was intrigued by when we're looking at the next energy, next. I'm obsessed. Next share price here. When is it expensive and when is it not? What's the sort of metric that the chief exec's using to decide whether to buy back shares or not?
He actually, funnily enough, if you go to the next report and accounts, he's got he actually gives you a formula in the report and accounts. That's one of the amazing things about Simon Wolfson. And basically he sort of calculates the yield that you're getting on a share buyback versus the yield that he's getting investing in the business. And obviously, as the share price goes up, the yield that he's getting on a share buyback goes down, and eventually get to a point where he turns it off. But he is incredibly transparent about it, so which is excellent. The point is that as I said, the average PE on these companies is about 8. I always think it's quite useful to flip a PE upside down and turn it from a price earnings ratio into a earnings yield. So, the earnings yield on these companies is probably sort of 13, 14%, that sort of figure. And so, share buybacks are when you're on that sort of earnings yield, do generate a lot of value.
Yeah, exactly. Good, thank you. Just looking at banks for a second.
Yes.
Obviously, we've had some quite decent share price rises, as you mentioned already.
Yep.
Does the fact that rates are now coming down make these things less attractive?
At the margin, but and that would be an issue if they were trading on high valuations. What's amazing is that they are still trading on very low valuations. They're all still trading at discounts to their tangible book. They're all still trading on sort of single digit PEs, et cetera, et cetera, et cetera. So I have to say we are really scratching our heads over why people are shunning banks and insurance companies in particular. Whether it's people were so scarred by what happened in 2008 that they sort of vowed never to invest in a bank again, Because the businesses are pretty robust at the moment. The balance sheets are very, very strong. As you say, the interest rate environment is pretty perfect for them at the moment, isn't it? Because it's high enough that net interest margins have gone up and therefore profits are good, but not so high that people are starting to sort of default on mortgages. So loan defaults are very, very, very low. Yes, if interest rates go back to sort of 1%, back to where they've come from, then obviously that would be bad. I just don't see that myself. I don't think we're ever going back to those days. I think those days were probably a one-off. So
I suppose the NatWest share price is probably helped by the fact we're not going to get this sort of massive retail share issue as well.
Yeah, and of course what they've been doing is their share buybacks. They've been buying the government stake, and just so the government stake has been coming down as the company have basically bought those shares and then cancelled the shares.
Cool. And in terms of sort of the balance sheet strength and the loan performance, that's still okay, is it?
They're still good. I mean, more than okay. So, it's so good that all the companies, when you look at the sort of regulatory hurdles that they have to go through, have got excess capital, and that's why they're using that excess capital to basically buy back stock.
Okay. And just a little bit more about Stellantis, if you don't mind.
Yes.
What I'm looking at is an enormous earnings yield.
Yes.
It's not. It must be doing. What's he doing with the cash? It's not paying all of it out.
No, it's not. It's been buying back shares. I mean, only, you can see only sort of 4% there, but it pays out a really high dividend. Autos have been quite weak actually recently, so Stellantis is one of them. I think the earnings were strong last year, and there's been a bit of sort of destocking in the US, and earnings have come down a bit this year. But again, that the valuations of these things are just absurd. So they reported this week. So we were chatting about this company this week. So the enterprise value to EBITDA, earnings before interest, tax, and appreciate and amortization, is 1.5 times for Stellantis. The dividend yield is double digit now. So you got, I think, a 10% dividend yield. The free cash flow yield is 20%. It looks to us to be a sort of stunningly cheap company.
And when you do get sort of volatility in share prices, is this always an opportunity to add to them?
Yeah, it is. It is. So we typically, the way that we invest is, we're value investors, so we're buying things that are out of favor, and they normally are out of favor because earnings are going down for some reason. It could be some strategic issue, it could be the economy, it could be the industry, and that doesn't normally change the day after we've bought them. So what we will normally do is we'll put on a position, 1%, 2%, something like that, and basically in the expectation that the share price is going to continue to be weak, and we'll sort of add to that share price on weakness. So yeah, we're not worried at all about share price weakness, so long as nothing has changed with the thesis of the company. To a certain extent, we welcome weakness in the share price. I mean, a fabulous example here actually has been one of our best performing companies over the last couple of years has been Marks and Spencer's. It's one of the largest stocks in the portfolio. We undoubtedly started buying that too early, so we started buying that probably actually before we started running Temple Bar, I think. And then of course we went into the pandemic, and the share price hit £1. It's about £3.30 today. And so that gave us an opportunity to really average down in Marks and Spencer. So we bought a lot during 2020, and really brought down the average in price in it. For anyone who's interested in it, the thesis there, it was a classic management turnaround. A guy called Archie Norman came in about 2018 as the new chairman, identified everything that was wrong with Marks and Spencer's, and there was an awful lot, and set about fixing it. And with these companies, it does take 5 or 6 years to turn things around. You cannot turn around a company like Marks and Spencer's overnight. But my word, have they turned it around? And that company now has absolutely amazing operating momentum. And I think the kind of exciting thing actually is they're probably only halfway around that through that journey of turning that business round. But that is back to your original point. That's a classic example of, I suppose, of us averaging down on share price weakness.
And how ruthless are you about valuation in terms of like kicking things out when you think they're going to be expensive?
So we're disciplined but not ruthless. So again, let me just stay with the Marks and Spencer's example. So the way that we invest is we try to figure out what we think what we describe as the normalized earnings power of businesses. So where do we think the earnings can get to in the sort of fullness of time? So in the case of Marks and Spencer's, we used to think that its food retail business should be able to do a sort of 4% margin, clothing and home about 11. That gets you to about 25p of earnings per share. And so during COVID, when it was trading at £1, you were buying it on 4 times our estimate of normalized earnings. They did 25p this year. Okay, so they've got to that figure much earlier than we expected. So and originally we'd said 25p, put that on a multiple of 12, that gets you at about £3. Now, share price today, I've just said to you, is £3.30, and yet it's still sat there on the portfolio. So why are we still holding it? Because we've gone back and looked at where we think the earnings can get to, and basically we think we were just too conservative, and that's good. You should be, if you're going to be wrong, you want to be wrong by being too conservative, not being over optimistic. And so actually we now think the earnings probably can be in the sort of mid 30s or so. So we revised up our estimate of the normalized earnings. We've revised up our estimate of the intrinsic value. And so we still hold the shares. If it gets to the point where the share price gets to a level where actually we don't think there's any reason to change our estimates, and we think it is fully valued, then that's the point at which it starts to come off the portfolio.
How many stocks are there in the portfolio altogether?
I think about 28, something like that.
And are there any shortage of value ideas out there?
I wouldn't say shortage, but they're quite concentrated. So if you look at this portfolio, we have quite a high weighting to energy, to financials, and to cyclicals, because those are the areas that for whatever reason investors have shunned in general, and so that's where we're seeing the value. I suppose another thing I would point to is that with Temple Bar we're allowed to invest 30% overseas, and so that's really useful. That does give us the opportunity to pick up things like Stellantis, NN Group, etc., etc. What would be nice would be if some of those so-called quality companies came down into a sort of level where we thought they were cheap, and we don't think they're cheap yet. I know over the last few years things like Diageo, Reckitt Benckiser, all those sorts of companies have performed pretty poorly, but only after a period in which they'd gone up very significantly. So we think they're getting cheaper, but we don't think they're attractive yet. That would be useful if those sorts of companies came back into a sort of
Diageo was the one that came to mind when you said that, to be honest, because I was looking at Nick Train's portfolio the other day, and it's come down a lot. Okay, cool. There's a couple of questions about valuations. I mean, obviously when you took it on, we had a big inflection in terms of like value, so it was perfect timing. But then the market's been quite distorted by the sort of AI stuff. Do you think that's a bubble? Is this just a repeat of internet in 2000?
Well, I think so. Yes. Could you go back to the very first chart in the presentation? So actually, just one before that. I mean, part of the reason that the US is so expensive, I think, is exactly that, isn't it? It's the fact that some of those big technology stocks are so expensive. But sorry, the reason for going to this one is that what we're looking at here is it's the spread in valuation between the cheapest part of the market and the most expensive part of the market. And as a proxy, you could call that value and growth. And value stocks by definition are always going to be cheaper. So again, this is a 50-year chart. And if you look at the dotted line is about minus 38. So by definition, value stocks on average are about 38% cheaper than growth stocks across that period of time. But as that line is going down, that's either value stocks getting cheaper or growth stocks getting more expensive, or both. And so go if you just take your eyes to sort of 1980. So that is basically, that's the sort of Nifty 50 bubble. So that's basically the Nifty 50 stocks. I know this is a UK chart, but it was a similar theme. So that was basically those sort of in vogue growth stocks getting very expensive, value stocks getting very cheap, and then you get a fabulous period of performance coming out of that. Look at 2000, that's exactly the same. So as that line is going down, that's internet and telecoms and media stocks getting more expensive, and things like BAT, getting cheaper and cheaper and cheaper. And then look where we are today. So we're at a wider level today than we were in 2000. And we had a fabulous 5 years post 2000, as did lots of other value fund managers, because the opportunities, as I say, the British, you could buy British American tobacco on a PE of 4 and a dividend yield of 8, and so on and so forth. And we're at a wider point today than we were back then. So, and this is two things. It is basically, as I say, things like banks, insurance companies, anything that's cyclical, being very cheap, at the same time as the sort of whole quality growth type area being very expensive.
Great, thank you. I think that's really interesting.
Yeah.
Now, one of the things that happened when you came on was the dividend was reset.
Yes.
So how important is it that Temple Bar's dividend is covered by revenue earnings?
Oh, it's very important. That's very important. I mean, we will never just invest for income. So we'll never just go and buy something that has given us a yield that we don't think is also fairly, cheaply valued. But at the moment, that's not a problem. At the moment, you're getting the best of both worlds. So you're getting businesses which operationally are doing quite well. Go back to our conversation on banks. Their earnings are covering their dividends, so you've got well-covered dividends, and therefore those dividends are growing. And I think, and actually one of the things that we're quite pleased at is how the dividend has recovered very strongly since that reset during COVID. The yield now is about 4%.
So there's a question here, which I think is an interesting one.
Yeah.
About the whole dividend hero thing, about growing your dividend every year.
Yes.
Do you think then, on that basis, you'd be prepared to cut it if you had a year where that you just couldn't cover it?
Yes, I think so. Nick and I have done this twice in our time, and I have to say on both occasions we weren't running Temple Bar. Now, it's worth making the point, isn't it, that one of the advantages of investment trusts is that you can use the revenue reserve to smooth the dividend, and you can't do that on an open-ended fund. But the open-ended funds that we were running in during the financial crisis, when we were at Schroders, we actually wrote to our investors and we said, "All right, we got some good news and some bad news. The bad news here is we're about to cut your dividends, and we're going to cut your dividend because we're basically going to go and buy a load of sort of beaten up companies who aren't paying a dividend at the moment. The good news is that you're going to be more than rewarded." Actually, could you keep going? Just go to that one there. Okay, so this is a fund that Nick and I have been running since 2000. So we've been running this fund for 24 years. Sorry, going back to my point. So in 2008, we wrote to the investors and said, "Look, we're going to cut your dividend because we're going to buy basically banks and house builders and insurance companies, etc., etc." So people lost, a couple of % of income, but you can see what happened coming out of the financial crisis. They were more than rewarded for it in the capital return that they got coming out of the financial crisis, and actually the dividends then caught up pretty quickly afterwards. We did the same thing during COVID. So during COVID, we wrote to our investors and we said, right, we're going to, a load of companies here which probably have sort of reduced or passed their dividends, but that's where the value is in the market. So we're going to rotate the portfolio into that area. And again, you can see, as I said to you, Temple Bar's up 120% since that point of time. So So yes, we are not. We don't have that same ethos that other people do, other income investment trusts do, about you've got to increase the dividend every year, because although in the long run that's good discipline, there are times when I think it leads to bad investment decisions, because it pushes you into it keeps you out of the areas of the market where there is very significant value but not yield, and sometimes it pushes you into the opposite. In other words, the sort of high quality but not very good value areas of the market.
Fair enough. That's really helpful, I think. A couple more questions on the portfolio, I think, before we wrap up. One about healthcare. Is there pharmaceutical stuff in there underneath?
We own GSK, but it's not in the top 10.
Okay. And what was the other one? Oh, ITV. Yeah. Just talk us through the ITV story, please.
Yeah. Again, we think this is fascinating. So people often, when they think of ITV, they basically think of the bit that they interact with, i.e., the TV station that they turn on in the evening. And what they don't know is that ITV has got a studios business. It's actually the second largest studios business in the world. Over 50% of its profits come from outside of the UK. So it's a really, really big and important studios business. And we think that studios business is probably worth nearly the whole of the market cap of ITV. So that's not, so basically the market is not putting any value at all on the broadcast business. We turn to the broadcast business. The broadcast business is going through a transition, and it's effectively the transition from analog to digital. So it's a transition to streaming. So most people will be aware that over the last couple of years they've been investing in this business ITVX. So they had to move to this new world where people want to stream things. That involved a significant amount of investment for a couple of years, but it was and that investment basically took down the earnings during that period of time, and the market does what it always does, which is just took a very short-term myopic look at the sort of short-term earnings trend, trash the share price. And the reality is that we think actually that was a very good investment. And again, that ITVX now sort of seems to really be coming through actually. So and actually, this share price has been a good performer this year. They also they sold a stake in BrickBox and used the proceeds of that to buy back shares. Yet another company buy back shares. And actually, as I say, it's performed very well this year. So we think that is a sort of turnaround story that's starting to come through actually.
Great, thank you very much, Ian. I think we've covered a lot of ground. We should probably wrap it up there. But thanks for your time this morning.
Pleasure.
Put the disclaimer up to make sure people get a chance to read it if they want to. You can always freeze frame and read it properly. And there's our one. But thank you, and we'll get you back in a year or so and see how things have been going. But it all seems to be in the right direction at the moment. So fingers crossed.
Cheers, James.
All right, bye.
Bye-bye.
Now, we will be next week talking to Craig Baker from Willis Towers Watson about the merger with Alliance and Witam, and what that means for that fund. And then, so we say we got a full lineup for the rest of the year. I've put on here brand new. These are the panelists for our 20th September Quality Panel show now. So we're going to be talking about what difference the new government's going to make to UK. And so we've got a couple of UK small mid-cap managers and a couple of infrastructure investors too. So that should be quite interesting. So thank you very much for your time today, and we shall see you next week. Have a good weekend.